Welcome to the deep dive. Today, we're really focusing in, cutting through the noise of the latest earnings call. Our mission is simple. Distill the absolute essentials from the CFO, Amy Hood's prepared remarks. We're looking purely at the financials, the forward guidance. It's all about the money, what they spent, why, and what it signals for the coming months. We know they're deep in this huge AI and cloud expansion phase. Growth is a given, right? But the real questions are, what's the cost of that growth? And maybe more importantly, are they now hitting limits because of their own success?
That's exactly it. That's the core tension you see running through her entire statement. I mean, the CFO confirmed Q1 was very strong. They beat expectations, revenue, operating income, EPS, the works. It definitely points to them continuing to gain market share. But, and this is crucial for you to understand right off the bat, these Q1 numbers, they reflect the business before that big new OpenAI agreement they just announced this week. That deal's impact is all future potential, not what drove these results.
Okay, good clarification. So let's dive into those Q1 headline numbers. Revenue hit $77.7 billion. That's, what, an 18% jump?
18%, yeah. And operating income grew 24%. EPS, adjusted for that earlier OpenAI investment impact, was $4.13, up 23%. Stellar numbers, no doubt.
But like you said, there's always a but. How sustainable is this when you factor in the AI race costs?
Well, that's where you start to see the strategy and the trade-offs. You have to look at the constant currency, or CC, figures she provided, stripping out the impact of exchange rates. So in constant currency, revenue growth was actually 17%, operating income 22%. Still very strong. It shows they're pushing hard for that top-line growth, maybe sacrificing a little short-term margin expansion to get it.
Right. And that showed up in the gross margin percentage. It was 69%, but I caught that. She specifically said it was down slightly year over year. Why the dip?
Okay, yeah. This is where it gets really interesting, strategically speaking. That slight decrease, she explicitly linked it to the investments needed for scaling their AI infrastructure. Think data centers, buying tons of cutting-edge hardware, GPUs, CPUs, to meet this surging demand for AI features. It's expensive stuff, especially up front. Now, they did offset some of that cost through pretty impressive efficiency gains in their established cloud platforms like Azure and M365 commercial. But make no mistake, the AI investment is the main reason for that slight margin compression.
So they're really ramping up the CapEx, the capital expenditure, to stay ahead. She gave a huge total CapEx number.
Right.
How did that break down in terms of actual spending?
Huge is right. $34.9 billion total CapEx. And it was all driven by that demand for cloud and AI. But it wasn't just throwing money around. They split it quite deliberately, almost 50-50, based on how long the assets last. So roughly half went to what they call short-lived assets. That's primarily your CPUs and GPUs, the raw compute power needed right now for training AI models and meeting platform demand. And the other half, that was for long-lived assets. We're talking 15 years or more. This is the big physical infrastructure build-out. It included $11.1 billion in finance leases, mainly for locking down and developing these massive data center sites around the world. So you see, they're investing for the long haul, for tomorrow's needs, while also scrambling like mad to keep up with today's demand.
That kind of spending takes serious financial muscle.
Yeah.
Did she give any color on their cash generation? Could they handle it?
Oh yeah, absolutely phenomenal cash flow. Even with that heavy CapEx, cash flow from operations jumped 32% to $45.1 billion. And free cash flow, that's the cash left after paying for all that CapEx, was up 33% to $25.7 billion. The core business is incredibly healthy, easily strong enough to fund these massive investments without, breaking a sweat.
Okay, let's unpack this next part, because these commercial commitment numbers, wow, they really signal what's coming down the pipeline. Commercial bookings jumped an incredible 112%. That's 111% in constant currency, doubled year over year. What on earth drove that?
Yeah, that number really stands out. The CFO highlighted two main things. First, really significant Azure commitments coming directly from OpenAI. And second, just continued strength in landing those huge deals, the $100 million plus contracts for both Azure and M365. The big enterprise customers are signing up. And here's another key point she made, that 112% bookings growth. It doesn't even include the extra $250 billion in Azure commitments they announced literally the day before these remarks.
That's incredible. So the demand signal is off the charts. How does that translate into future revenue? We need to look at the remaining performance obligation, the RPO.
Exactly. The RPO is basically the backlog of contracted revenue they expect to recognize. It climbed to a massive $392 billion. That's up 51% year over year. But here's the really critical thing for you to understand about that number. The pace. That RPO balance has almost doubled in just the last 2 years. Yet the weighted average duration, how long those contracts run, stayed stable at about 2 years. What that tells you is customers are signing huge deals, but they're relatively short term. They plan to use that capacity fast. This isn't speculative long-term stuff. It's immediate confirmed demand.
So putting it all together, the overall Microsoft Cloud revenue picture was pretty rosy.
Very rosy. Total cloud revenue hit $49.1 billion, growing 26%, or 25% constant currency. And the cloud gross margin percentage held at 68%. Again, you see that strategic trade-off playing out. They're getting more efficient, definitely. But those gains are basically being plowed right back into building out the AI infrastructure to try and meet the demand we just talked about. It's a balancing act. Okay, maybe we should quickly touch on the three main business segments. It's interesting to see where the profit's coming from and where the bottlenecks might be. We can use their acronyms. PBP for productivity and business processes, IC for intelligent cloud, and MPC for more personal computing. Starting with PBP, think Office 365 Dynamics. Revenue was $33 billion, up a solid 17%. This is really their efficiency engine. M365 commercial seats grew 6%, mostly smaller businesses and frontline workers, so good market penetration there. Dynamics 365 also did well, up 18%. And look, the operating margin, it actually increased 3 points to 62%. PBP is the stable profit generator.
Okay, now I see intelligent cloud. This is Azure, the heart of the AI and cloud story.
Right. IC revenue was $30.9 billion, up a very strong 28%. Azure and the other cloud services grew 40%. That's 39% in constant currency, mainly driven by demand from their biggest customers for core infrastructure. But here it is, the absolute kicker for the quarter. Demand for Azure AI services actually exceeded their supply. They just couldn't deploy compute capacity fast enough to meet all the demand they had. It's a huge point. Despite that, operating margins for IC held steady at 43%, which is pretty remarkable given the scale of investment going in.
Demand exceeding supply. Yeah, that's what you'd call a high-class problem, but still a problem. Okay, finally, MPC, more personal computing Windows, Surface, Search.
MPC revenue came in at $13.8 billion, up 4%. A bit more mixed here. Windows OEM and devices revenue was up 6%. That got a boost from people buying ahead of Windows 10 end of support. Plus, interestingly, inventory levels were apparently quite high at the end of the quarter. Search and news advertising also had a good quarter, up 16%.
All right, let's pivot to the future. Looking ahead to Q2, the next quarter. If Q1 was about massive demand and spending catching up, what's the vibe from the CFO for Q2?
The vibe is definitely pedal to the metal on investment. Even faster. Q2 total revenue is guided between $79.5 and $80.6 billion. That implies growth of about 14% to 16%. Still strong. But look at the cost side. Cost of goods sold growth is forecast way higher, 21% to 22%. That directly reflects the need to keep scaling rapidly and the high cost of doing so. As a result, they expect operating margins to be basically flat compared to last year.
So that capacity issue from Q1, they must be pouring even more cash into CapEx in Q2 to try and fix it.
Absolutely. CapEx is expected to increase sequentially, meaning more spending in Q2 than Q1. But the really telling forecast, the one that signals this isn't a short-term issue, was about the next fiscal year, FY26. The CFO stated that the CapEx growth rate for fiscal 26 is now expected to be higher than the rate for fiscal 25. They're not seeing the peak demand yet. The bookings, the RPO, it all points to continued exponential growth in demand for infrastructure. They need to keep building faster and faster. And this brings us right back to that capacity bottleneck, linking the incredible demand to the physical limits. For Intelligent Cloud in Q2, she expects Azure revenue growth around 37% in constant currency. Phenomenal scale, right? And this was a very clear, direct warning. She said demand remains significantly ahead of available capacity. They expect to be capacity constrained through at least the end of this fiscal year. That's a long time. It means tough choices every day. Balancing that lucrative Azure growth against the compute needs of their own apps like M365 Copilot, R&D efforts, and just replacing older servers.
Wow. So they're running this incredibly successful machine, but it's redlining, essentially hitting a physical bottleneck. What about Q2 drivers for the other segments?
Yeah, for PBP, they expect M365 commercial cloud growth around 13% to 14% constant currency. That's driven by customers moving to higher tier plans like E5, and increasingly the adoption of M365 Copilot, which boosts the average revenue per user, or ARPU. For MPC, on the other hand, they expect Windows OEM and devices revenue to actually decline mid-single digits. That's because those elevated inventory levels they saw building up at the end of Q1 are expected to come back down in Q2. It's a normalization.
Okay, so let's try and summarize the core finding here from the CFO's remarks. It seems Amy Hood basically confirmed that demand signals, whether it's bookings, RPO, actual usage, they're all accelerating way faster than even they expected. And that's forcing them into this massive ramp up in investment infrastructure, AI talent, even if it means margins stay flat for a while, just to capture that long-term opportunity. It really is a race to build, and right now the demand is winning.
That's it perfectly. The whole financial story she presented is dominated by that core tension. On one side, you have these incredible near-term commercial commitments. That $392 billion RPO is the symbol of that. Huge confirmed demand. On the other side, you have this urgent, incredibly expensive race against time to deploy enough physical compute infrastructure, GPUs, CPUs, data centers to actually meet that demand. They're spending billions to try and keep the promises embedded in those contracts. And that leaves us with a really interesting thought for you, our listener, to chew on. Given that the CFO was so explicit, saying they expect to be capacity constrained right through the end of the fiscal year, what impact could that kind of prolonged, expensive supply bottleneck at the very top of the market have on the rest of the AI landscape? Think about smaller cloud providers or even just customers all competing for that same limited pool of advanced computing resources. What does it mean for them?